John Sunt, you recently launched the Altegris Equity Long Short Fund. Why is this different from other hedge fund vehicles?
Equity long short is an important category for hedge fund investing. The Altegris approach has been defined best of breed managers that really have experience shorting the market. So we have found 4 managers that have tremendous experience, some of them over a decade of experience. A lot of the equity long short funds out there say they're good long short funds, but the actual managers don't have true history of shorting stocks.
And this is a mutual fund that acts like a hedge fund, so it's cheaper, right? How much does it cost?
We have an expense cap on the fund. It's not as expensive as most hedge funds. To get best of breed managers, we feel it's talent worth paying for. This fund runs at about a 3% expense ratio. But again, remember, you're gaining access to managers that prior to now have been unavailable in a mutual fund format.
And you're not giving away 20% of the profits, which is the fun part, I suppose, when the fund makes money. So how do you know when to drop the managers? It seems like you're finding very good managers. How do you know when it's time to get rid of them because they aren't performing as well as you originally intended?
Altegris has 8 people on our due diligence and research team. This is our DNA. Alternatives is all we do. We spend a tremendous amount of time evaluating sub-advisors for our various products. And we'll look at peer reviews, we'll look at benchmarks, we'll look at due diligence limits that managers have told us that they won't violate. And if a manager is underperforming relative to his peers or violating risk parameters perhaps that he's given us, we'll fire the manager.
Why is now a good time to get into a mutual fund like this?
It's a stock picker's market right now. The dead cat bounce after 2008 is over. Anybody could have made money after 2008 just by being exposed to the market. There is so much risk in the market right now. It's really a great environment for a stock picker, especially a manager that has the ability to go short some stocks. So this is the idea here is you want to be exposed to equities, you want to be exposed to the market at certain times, but you also want to have a short component.
And how much exposure should one put into a fund like this? All their assets, or 20%, 5%? How do you get into a fund like this in terms of how much to put in from your holdings?
Most investors know that endowments put maybe 30 or even 40% of their assets into alternative investments. Pretty high for the individual. The average affluent investor that has maybe $1 million portfolio or a $500,000 portfolio, we're thinking that 10 to 20% in alternatives makes sense. Of the alternatives section, this might be a 25 or 30% holding.
This market is
Stock pickers market.
Stocks have rallied this year.
We're coming into a Monday where we're going to